Adjusted sales of $6.5 billion, right? Organic growth hitting 5.4%. EPS up 11% year over year to 2.4 euro. And full year guidance officially raised. 3M just dropped this massive Q2 earnings beat.
Yeah, and the market is definitely paying attention to it.
Exactly. I mean, to understand how a legacy tape and sandpaper company is quietly becoming a backbone of the AI revolution, you really have to look past the headline numbers.
Right. They didn't just beat the quarter, they actively signaled like supreme confidence in the back half of the year.
For sure. And the stock reacted immediately.
Well, it's a market that's just currently starved for execution, right? And 3M delivered exactly that. I mean, they are now projecting their full year adjusted EPS to land between 8.80 and 8.95.
Which is a huge jump.
Yeah, a very healthy bump from the 8.50 to 8.70 range they gave us back in April. Plus, they confidently stated organic sales growth will safely clear 3.5% for the year.
Okay, let's unpack this, because we know 3M beat those top line and bottom line headline numbers.
Yeah, but the most telling signal wasn't even the EPS bump, actually. It was their guidance on liquidity. They're projecting a free cash flow conversion rate greater than 100% for the full year.
Right, so for retail investors listening to this, we need to look at exactly how they pulled that off. Like, how do you extract an 11% explosion in earnings per share from just 5.4% in organic sales growth?
You have to squeeze massive operational leverage out of the business.
You simply don't get that kind of bottom line acceleration otherwise.
No, you don't. And we are seeing that leverage materialize directly in their margins. I mean, their adjusted operating margins expanded by 40 basis points, bringing them up to 24.9%.
Which, for anyone not staring at a Bloomberg terminal all day, 40 basis points is just under 0.5%.
Exactly. And that might sound like a rounding error if we were talking about, I don't know, a high-margin software startup.
Yeah, but for 3M...
Right. For a diversified industrial giant that is manufacturing and moving millions of physical goods across the globe every single day, nearly 0.5% of margin expansion is a highly meaningful efficiency gain.
Let's pause on that 100% free cash flow conversion number you brought up a second ago, because that can sound a lot like accounting magic.
It really can, yeah.
What does a 107% conversion rate for the quarter actually mean in plain English?
So it basically means that for every single dollar of accounting profit 3M claimed on paper for the quarter, they actually deposited $1.07 of cold, hard cash into the bank.
Wow. Okay.
It proves the quality of their earnings. And they generated a phenomenal $1.3 billion in free cash flow just this quarter alone.
Which totally explains how they're returning so much capital to shareholders. I mean, they handed back $1.4 billion in Q2.
Yeah, bringing their first half total to $3.8 billion.
Right, split between their dividend and some very aggressive share buybacks. Specifically, $3 billion spent on gross buybacks in just the first half of the year.
It's massive.
But I want to look at the actual EPS bridge for Q2, because this lays out the literal math of how they navigated the quarter.
The bridge is always telling.
Growth and productivity initiatives added 36 cents to the EPS, and the lower share count, thanks to those billions in buybacks we just mentioned, added another 8 cents.
Yeah, but they absolutely needed every single one of those wins.
Exactly, because they had to offset a painful 20-cent drag from tariffs, stranded costs from previous restructurings, and, internal investments.
Right, and that 20-cent headwind is a stark reminder that the macro environment is still incredibly noisy. Global tariffs and supply chain friction haven't just vanished.
No, not at all.
But that's exactly why that 36-cent boost from growth and productivity is the most vital number in the bridge. It proves that management's internal efficiency initiatives are actually sticking on the factory floor.
Yeah, they highlighted some very specific metrics to prove this, right? Overall equipment effectiveness, or OEE, is up 140 basis points.
Yep, and their cost of poor quality is down 60 basis points.
I need to interrupt and push back on those metrics, though, or at least play devil's advocate for a minute.
Go for it.
I used to look at 3M as this massive, slow-moving cargo ship adjusting its course in the middle of the ocean.
Yeah.
Heavy, sluggish, taking forever to turn.
Very common view, yeah.
And now management is throwing around acronyms like OEE going up 140 basis points and cost of poor quality dropping. To a skeptic, is this genuine, sustainable operational leverage?
Or is it just a temporary cost-cutting sugar rush?
Right. Are they just deferring factory maintenance and starving their R&D budget to juice the margins for a couple of quarters?
What's fascinating here is that the cash flow conversion we just talked about proves this is a real sustainable turnaround. You simply cannot fake cash in the bank.
That's a good point.
If this were a temporary sugar rush, like if they were just starving the business of necessary capital, you would instantly see their working capital deteriorate.
But they didn't.
No, 3M noted strong working capital improvements across the board. They specifically called out a reduction in inventory days.
Meaning they aren't just piling up unsold goods in a warehouse somewhere.
Precisely. And to answer your question about the factory metrics, OEE going up means the machines on the assembly line aren't sitting idle waiting for parts.
They aren't breaking down as often.
Exactly. The entire line is humming seamlessly, and the cost of poor quality going down means they are drastically reducing waste, rework, and scrap material.
So they're manufacturing more efficiently.
Right, producing less garbage and moving the finished usable goods off their balance sheet and into the customer's hands much faster. That isn't accounting fluff.
No, that is tangible operational discipline generating real liquidity.
Exactly.
But does that liquidity hold up if the underlying sales mix falls apart? Because when I dig into the segment breakdown, it feels like a tale of two completely different economies right now.
Oh, absolutely.
We are looking at a classic barbell economy, and I want to see how 3M is balancing the weights.
The segment data is a perfect, almost uncomfortable mirror for the broader macroeconomic environment. On one side, you have immense heavy-hitting strength in industrial and enterprise tech spending.
Right, and on the absolute opposite side.
You have very real weakness at the everyday consumer checkout line.
So let's break down the weights on this barbell, starting with the heavy lifting. The safety and industrial segment is the undeniable workhorse of 3M.
Yeah, making up roughly 50% of their total sales.
They clocked $3.09 billion in revenue here, with an impressive 8.2% organic growth rate.
Driven by low double-digit growth in electrical markets, adhesives, and abrasives.
Even roofing granules, which had been a sluggish business line for them recently, finally returned to growth.
That low double-digit growth in electrical markets and adhesives is a massive leading indicator for industrial expansion. I mean, adhesives and abrasives don't just sit on a shelf.
They go into literally everything.
Everything from automotive assembly lines to massive commercial construction projects. When you see those specific material lines up double digits, it means factories globally are running hot.
And physical infrastructure is actively being built.
Exactly.
Which brings us to the transportation and electronics segment. This makes up about 30% of their sales, pulling in $2.06 billion for the quarter.
And organic growth here was 5.9%.
But the divergence within this single segment is wild. Semiconductors, aerospace, and data centers grew double digits.
Right, well, auto was flat. But 3M went out of their way to note they are increasing their content per vehicle, allowing them to outperform the underlying flat auto market.
But then on the flip side, consumer electronics were down low single digits due to weak end markets and industry-wide memory shortages.
You really have to view this transportation and electronics segment as 3M's transition vehicle into the digital and electrified economy.
The data center growth is the artificial intelligence infrastructure build-out showing up in physical material supply chains.
Yes, and the aerospace growth is the continued post-pandemic travel boom, finally clearing out historical manufacturing backlogs.
But the auto market dynamic you mentioned is critical. How do you grow revenue in a flat auto market?
You do it because modern electric vehicles require significantly more thermal management materials, battery housing films, and advanced adhesives per car than legacy internal combustion engines.
So they're taking a significantly bigger slice of a pie that isn't growing.
Exactly.
But then consumer electronics being down ties perfectly into the other, much lighter side of the barbell analogy. Let's look at the consumer segment.
This is roughly 20% of their total sales, bringing in $1.25 billion.
And organic growth here actually fell 2.1%. The commentary management provided here is critical. Right?
Yeah, 3M said that despite seeing improving point-of-sale trends and actually gaining market share against their competitors, U.S. retailers aggressively reduced their channel inventories.
Which is a massive macroeconomic red flag on the retail side.
When major retailers destock aggressively, it means they are looking at consumer credit card debt, they are looking at sticky inflation, and they are panicking.
They don't want capital tied up in backroom inventory if consumer spending falls off a cliff.
Right.
Wait, so let me get this straight. They are selling fewer consumer goods, taking a 2.1% hit on a fifth of their business because retailers are panicking.
Yeah.
But they are still raising their full-year earnings guidance. How is 3M managing to thrive when a massive chunk of its business is fighting an uphill battle against retail inventory cuts? Like, is that actually sustainable?
It is. And synthesizing this data, you realize that 3M's sheer sprawling diversification is its primary shield. Think about the mechanics of how a spec win in an enterprise data center works.
A spec win.
Yeah, so a hyperscaler like a Microsoft or an Amazon decides to build a massive AI server farm. They specify or spec in 3M cooling materials or advanced optical cables into the architectural blueprints.
Okay.
Those are incredibly high-margin, sticky, multi-year contracts. The immense profitability in those enterprise spec wins is currently acting as a perfect counterbalance, completely offsetting the tepid U.S. consumer recovery.
Wow.
If 3M were purely a consumer brand, that 2.1% drop and the retailer destocking would have absolutely tanked the quarter. But because they have the safety and industrial engine pumping out 8.2% growth, they can absorb the consumer weakness without missing a single beat on the bottom line.
So maybe my old cargo ship analogy really was wrong. 3M isn't a ship, it's more like an operating system for the physical world.
I like that.
You don't really see it, but its adhesives, films, and ceramics are the background code keeping everything running.
That's a great way to put it.
And since data centers are clearly this massive bright spot in the transportation and electronics segment, we have to look at the specific materials and the R&D pipelines fueling that growth.
Right, because 3M isn't just selling sticky notes and Scotch tape, they are a heavy-duty innovation factory.
They absolutely are. And management spent a very deliberate portion of the earnings report highlighting the speed of their R&D engine.
They launched 92 brand new products in Q2 alone. That is up 44% year over year.
And they stated they're on track to launch over 350 new products for the full year. What stood out to me wasn't just the sheer volume of products, it was the velocity.
The cycle times.
Yeah, they noted that their cycle times for product development, the time it takes to get an idea out of the lab and into the market, are down 20% since 2024.
Which is huge.
But here's where it gets really interesting. They announced a massive definitive win with something called Expanded Beam Optics, or EBO.
Right.
Microsoft is officially the first hyperscaler to deploy 3M's EBO technology for their AI data center infrastructure. Now, for anyone who doesn't spend their weekends in the server weeds, these are contactless, dust-resistant optical connectors.
And in a modern AI data center, you are moving terabytes of data between thousands of GPUs in milliseconds.
Exactly. Even a microscopic speck of dust on a traditional optical fiber connection causes massive signal loss and latency.
3M's EBO completely solves that by expanding the beam of light across a contactless gap, which lowers maintenance costs and drastically speeds up installation time.
That's brilliant.
If we connect this to the bigger picture, shrinking those R&D cycle times by 20% is exactly how a legacy material science company reinvents itself for the AI age.
Being able to move fast.
Yeah. When you can move from a lab concept like expanded beam optics to a commercialized product installed in a Microsoft server farm 20% faster, it means 3M can monetize niche materials rapidly.
And they aren't just doing this with EBO.
No, the report specifically highlighted their Nextel ceramic fibers, which are engineered for extreme thermal environments, and specialized space films for light management.
So they're taking their legacy core competencies in films, ceramics, and adhesives and putting them directly at the highest growth, most technically demanding sectors on the planet.
This entirely reignites their reputation as an innovation powerhouse.
They are even using AI internally to speed up their own sales cycle. They just launched Ask 3M, which is an AI digital assistant powered by AWS.
Oh, right, the technical assistant.
It's designed to help their enterprise customers evaluate highly complex materials, compare product specs, and resolve application challenges instantly without having to wait for a field engineer to call them back.
It's essentially self-service technical expertise,
Plus, on the material science front, they secured a long-term Airbus A220 installation agreement. And this was just incredibly cool. They became the official material science partner for the Cadillac Formula One team.
Which is brilliant, because an F1 partnership is actually a classic high-stakes material science proving ground. Formula One provides arguably the most demanding thermal, vibrational, and aerodynamic environment in all of sport.
It really does.
The extreme temperature adhesives, friction coatings, and heat shielding materials that 3M develops for that Cadillac F1 car will inevitably be reverse engineered and trickle down into their commercial automotive aftermarket and OEM segments.
It's the ultimate stress test. But, while the future looks undeniably bright with AI data centers and F1 cars, the reality of the balance sheet requires looking at how 3M is actively reshaping its portfolio and dealing with some very heavy past liabilities.
Yeah, it's not all just high-tech growth and shiny new products.
Yeah, there's a massive amount of corporate housekeeping going on behind the scenes.
I mean, portfolio management is a dominant part of the 3M narrative right now. On the acquisition front, they just closed the purchase of Madison Fire and Rescue on July 1st.
And management noted this will add about $200 million in second-half sales, and it comes with very attractive mid-30s EBITDA margins.
But they also actively shedding assets that no longer fit the core mission. They recorded a $336 million loss on the divestiture of Dyneon GmbH.
And that divestiture loss bleeds right into what I think is one of the most critical parts of this earnings report for retail investors to truly understand.
The gap.
Yes, the massive glaring gap between their GAAP earnings and their adjusted earnings.
Right. We talked at the very beginning of this deep dive about the adjusted EPS of 2.40, which represented that 11% beat.
Yeah.
But if you look at the raw, unadjusted GAAP EPS, the generally accepted accounting principles number, it was only $1.78.
That is a 62-cent gap between GAAP and non-GAAP EPS.
Yeah.
Look, I have to challenge this. A 62-cent gap between what they actually paid out and what they are telling us they earned is a massive chasm.
It is.
For you listening, this gap is driven by heavy adjustments, specifically special items that management gets to back out of the adjusted numbers.
Which include what?
Well, the report details $183 million in net costs for significant litigation and the PFAS exit. And just for context, PFAS are often referred to as forever chemicals, and 3M has made the strategic decision to completely exit manufacturing them due to the massive environmental liabilities they carry.
Right, they're stepping away entirely.
So this $183 million hit references the Combat Arms earplug settlements, the public water supplier settlements, and that broader PFAS exit. There was also $100 million in transformation restructuring costs and adjustments for changes in the value of their retained Solventum spinoff ownership.
All very significant line items.
So my question is this. Are analysts just giving 3M a free pass on their past liabilities? Retail investors see 1.78 in real GAAP earnings. Why should they rely on this pristine 2.40 adjusted number?
This raises an important question, and it's one every single financial analyst has to grapple with when evaluating legacy industrial conglomerates with decades of history.
Right, why ignore it?
Well, why do we willingly separate out the transformation costs and the PFAS exit settlements? It's because analysts are trying to value the go-forward earnings power of the core business. Yes, these are very real cash outflows. To be precise on the reporting, the company noted net pre-tax cash payments of $858 million in Q2 related to net costs for significant litigation and the PFAS exit. You cannot ignore nearly $1 billion leaving the balance sheet.
Definitely not.
But these are finite strategic cleanups. The litigation settlements have legally defined timelines and caps. The transformation costs are a one-time structural redesign of their global manufacturing and distribution footprint.
Ah, I see.
By separating them out, you allow the core business, the tapes, the abrasives, the optical cables we just discussed, to be evaluated on its own distinct merits.
So the GAAP numbers tell you what the whole corporation, including its legal department, paid out this quarter.
Exactly. And the adjusted numbers tell you how the actual factories are performing. And as we've seen, the factories are performing exceptionally well.
That's a highly clarifying way to frame it. The cash is indeed leaving the building, but it's leaving to pay off finite ring-fenced obligations. It isn't being burned to prop up a failing business model. The underlying business model is what's generating that 107% free cash flow conversion we talked about at the top of the show.
Right. And that robust cash generation from the core operations is the only reason they can successfully fund these legacy liabilities while still buying back $3 billion in stock and paying a healthy, consistent dividend to their shareholders.
So bringing this all together, we're looking at a company successfully navigating a deeply bifurcated economy. They are using disciplined, granular cost-cutting, getting that factory floor OEE up, and the cost of core quality down.
And combining that with high-tech R&D velocity.
Yes, combining that to fund their transition away from legacy liabilities and everyday consumer headwinds. They're letting the heavy-duty, safety, and industrial segment do the heavy lifting while planting massive high-margin seeds in the AI and aerospace sectors.
It really is a textbook example of leveraging a conglomerate structure. You fiercely optimize the cash cows, you restructure the messy supply chain, and you pivot your elite R&D teams directly toward the fastest-growing end markets on the planet.
So what does this all mean? I want to leave you with a final thought on that Microsoft deal we discussed. 3M didn't just sell a neat new product to Microsoft. They helped establish the Multi-Source Agreement, or MSA, for expanded beam optics.
Which is a huge deal.
Right, an MSA is essentially an industry consortium officially agreeing on a universal standard.
Standardizing the tech?
Yeah. If this contactless, dust-resistant connector becomes the absolute gold standard for every hyperscaler data center on Earth to prevent signal disruption, how much of the coming trillion-dollar AI infrastructure boom will quietly rely on 3M's material science?
It's a fascinating foundational layer to the AI narrative that doesn't involve buying a single GPU.
It's the ultimate picks and shovels play for the artificial intelligence gold rush.
Truly.
If you want to keep tracking these deep dives into the financials that are quietly running the global economy, make sure you follow the show for our daily earnings coverage. See you next time.